Hello, Altitude viewers. It's Mike Riley here on a Friday talking about found money. If any of you have purchased a mortgage and received one of these forms here offering you mortgage insurance held by the lender, this is directly targeted to you. There is a way for you to absolutely save money on what it's costing you um, to cover the insurance on that mortgage. So it looks like math. Don't be concerned. It's actually relatively simple. On this side here, we're going to try and do some apples to apples comparison of standard mortgage insurance versus personally held insurance. So I don't want to go into the differences between the two of them here, except just to focus on price. There's a lot of differences when you look under the hood, but just if you are cost conscious, owning your own personally held life insurance can actually be a big saver for you um, than just going with what's been offered when you get your mortgage. And mortgage brokers are obligated to offer that to you. And it's not a bad idea to do if you don't have any because it protects you right away if death happens within about 30 days. But I urge you to take a look at getting your own personally held insurance. Why? Let's just look at the prices. So on this particular example here, we're looking at a couple, husband and wife, and they're 30 years old. They got a mortgage for $420,000, and the monthly premiums are $55 a month through the lender offered insurance. So if either one of them die and it pays out, the bank will get paid $420,000 to pay off the mortgage. That same insurance, if they were to sit down with an insurance professional and have it underwritten, would be for $420,000 would be $38 a month. So right away you're saving some money on that policy. Now the bank only offers you exactly the same amount for the mortgage, and insurance, like a lot of other things, gets less expensive per unit the more you get. So if this couple was to say, well, 420,000 only covers the value of the mortgage, if either one of them died, they might not need a little bit more insurance for other expenses. If they increase that amount to 500,000, so $500,000, it's actually only $39 per month, assuming standard health and they're non-smokers. So right away, we can get more insurance for them personally held than if they stayed with the offering through the lender. Now that's jointly held, so if the mortgage on this side here, if either one of them dies and it pays out, then the insurance is finished and the surviving spouse has no more insurance. With most of the products that a professional insurance advisor like myself use, we do have the option of offering a new amount of insurance to the surviving spouse under a joint policy. That's a little bit of extra detail. But I usually prefer to offer the same insurance to both parties, to husband and wife, or husbands and wives, because for the same, you can actually get more insurance again for less. So if each of these individuals got the $420,000 of insurance that each of them held, the amount for that mortgage for that insurance would be $44 per month. So that's $840,000 of insurance that the family now owns that still costs them less than what's been offered by the bank. What's the other thing you need to know about the difference between the two? So I think you can agree that you already are ahead on cost. But let's take a look at the product themselves. The bank insurance of $420,000 for the mortgage, it's going to start at $420,000, but what happens? You're paying your mortgage down. That amount is going to diminish, and it's going to go like that as you pay it down until you sell the house or you are actually fortunate enough to pay your house off in total, $420,000. But you are paying $55 a month that whole time for insurance that's dropping in value. So even though you started at $420,000, some years down the road, you're still paying $55 a month for far less insurance. Compare that to what happens with your personally held life insurance. That same $420,000 goes all the way to age 85, and it never diminishes. So it doesn't matter that you're paying your mortgage down, you're still underwritten for that same amount. The one drawback with personally held insurance that people need to be aware of is that it does increase in cost over time. So the first 10 years are relatively inexpensive. So that's, let's say it's $40, and then it's going to double to 80, and it's going to double, and it's going to double until you cancel. So that's something to be aware of. This is a level cost. This is an increase in cost. In my practice, I work with my clients regularly, usually annually, to take a look and see, do we need to adjust the insurance? And as we get to one of these increase periods here, we'll often replace it with a brand new policy that's only slightly more than what they're already paying. So the fact that we get those big jumps is not really relevant if you're working with a professional advisor. So I hope this has been informative to you. If you have insurance that you signed on a form like this, please reach out to a professional advisor. You can contact me through the email contacts below, or work with someone that you're already working with if they're taking care of your finances, and see if it makes sense to replace this bank-held lender creditor protection insurance with something that you own yourself. So it's Mike Riley with Altitude Financial, helping you gain altitude and gain confidence.